Okay, let's dive into this. Welcome to today's Explainer. We're doing a critical deep dive into cross-border tax myths. And specifically, we're looking at a massive blind spot for returning non-resident Indians who decide to bring their remote jobs back home with them.
So here's the big question. Think your foreign salary stays tax-free because you're RNOR?
Well, that assumption could be expensive. Listen, many NRIs move back to India but continue working remotely for employers in the US, UAE, or the UK. They often just assume that because their salary comes from abroad, and hey, they qualify as RNOR, it won't be taxed in India. But honestly, that's simply not how salary taxation generally works. RNOR is absolutely not a blanket exemption for all foreign income.
Now, what's really interesting about this is how we're going to untangle the myths from the realities of Indian tax laws for remote workers. We'll quickly touch on the RNOR trap, the physical source rule, active versus passive income, employer PE risk, double taxation, and finally, how to structure things safely. All right, let's jump right into the core of this, the RNOR tax trap and the physical source rule. For employment income, the absolutely crucial principle here is where the work is actually performed. Under Section 911I of the Indian Income Tax Act, salary is deemed to accrue or arise in India if it's earned for physical labor executed within Indian borders. It's really all about the physical location of the worker, not where the employer is headquartered.
Let me make this incredibly clear, because it catches so many people off guard. If you are physically sitting in India and carrying out your employment duties here, the salary attributable to those services may be taxable in India. Period. Even if your employer is thousands of miles away and your salary drops right into a foreign bank account, it's your physical presence that triggers the tax.
So, the crucial point is understanding the difference between passive and active income.
You see, RNOR is fantastic for passive income. It successfully shields passive assets sitting abroad. If you've got foreign rent, foreign bank interest, or maybe dividends from US or UK stocks, those remain completely exempt from Indian tax during your RNOR period. But compare that to active income. Your remote salary, earned while you're physically working in India, requires the continuous exertion of your labor right now on Indian soil. That makes it active, local income, and yes, fully taxable.
And this brilliantly illustrates the concept through a couple of real-world scenarios. Take Rahul. He returns from Dubai but keeps his remote UAE job, getting paid right into his Dubai bank account. But because he's physically doing the work from his laptop in Bangalore, his salary is fully taxable in India. On the flip side, look at Sandra. She's a U.S. resident renting out her Mumbai flat, and the rent goes straight to her U.S. account. Since the asset, which is the flat, is physically in India, that income is taxable in India. It always comes back to the physical source. Now, things get even more complicated when we talk about employer permanent establishment risk. This isn't just a headache for the employee. Foreign companies with remote workers in India can accidentally create a permanent establishment, or PE. It's a massive corporate risk. According to OECD guidelines, tax authorities look at two tests. Step 1 is the temporal test. Is the employee working in India for more than 50% of the year? If yes, we move to Step 2, the disposal test. If the employer doesn't provide a workspace in India and requires you to work from home, that home office is legally considered at the disposal of the employer. This can actually trigger a fixed place PE, exposing the foreign company's profits to India's 40% corporate tax rate. Yikes. And the stakes get higher with severe withholding obligations. Corporate tax insights highlight that under Section 192, employers paying taxable salary to an employee in India are legally mandated to deduct tax at source, or TDS. If a foreign employer fails to deduct Indian TDS on a remote worker's salary, they could be held liable as an assessee in default. We're talking substantial interest and heavy penalties here.
Let's move to a major pain point: double tax and treaty relief. What happens if the US or UK also taxes that same remote salary?
To avoid paying taxes twice, we rely on double taxation avoidance agreements, or DTAs. Under Article 15 of most treaties, like the US-India one, if you're physically present in India for more than 183 days, India gets the primary taxing rights on your employment income. Double taxation is then resolved using foreign tax credits. For example, a U.S. remote worker sitting in India would file IRS Form 1116 in the U.S. or Form 67 in India to offset the taxes already withheld. It's a lifesaver, really.
Now, fixing this right at the payroll level to avoid that painful temporary double taxation, it's tricky, but totally possible. A recent Authority for Advanced Rulings decision confirmed a very practical solution. Employers can sometimes allow credit for foreign taxes paid when they're calculating the Indian tax withholding for resident employees. But, fair warning, this requires some seriously robust internal processes from the employer to verify those foreign tax credits precisely when they withhold the tax.
All right, so how do we actually handle this? Let's talk about structuring remote work safely.
There are generally two safe, compliant routes you can take. Route 1 is using an employer of record, or an EOR. They hire you locally in India on behalf of the foreign company, handle all the Indian payroll and TDS, and entirely eliminate that scary PE risk for your employer. Route 2 is setting up as a true independent contractor. In this setup, you invoice your clients directly, manage your own GST, and file your own taxes, potentially using the presumptive taxation scheme under Section 44A.
But I have to give a huge warning here. Simply slapping the label contractor on a full-time remote worker won't fool Indian tax authorities for a second. They use a strict multi-factor test to sniff out hidden employment. They're going to look at who actually controls and supervises the work, whether you're fully integrated into the business, who provides the tools, like did they buy your laptop, and whether you bear any real commercial financial risk. If you look and act like an employee, you're going to be taxed like one, and your employer will be on the hook. So, here's the bottom line. Before relocating, review your employment arrangement, your tax residency, and any applicable tax treaty to truly understand your obligations. Please, don't wait until tax season to figure out you've accidentally created a massive liability for yourself and your company. The ultimate takeaway is super simple to remember. Remote job, global employer, local tax rules. No matter where your employer's headquarters are or where your bank account is located, the local tax rules of the physical chair you are sitting in are the ones that apply.
So I'll leave you with this to chew on. Is your cross-border setup actually compliant, or are you sitting on a tax time bomb? It might just be time to review your strategy, chat with a cross-border tax professional, and make sure your remote work dream doesn't turn into a tax nightmare. Thanks for joining me on this explainer, and I'll catch you next time.